Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a deceptive calm ends as markets restart with geopolitical storms brewing. With tariff deadlines and a Fed under siege, will the S&P 500's fragile highs survive the opening bell, or is a major reversal imminent? Second, the Big Short 2.0. Michael Burry's new high-stakes bet against Nvidia targets the AI boom's hidden vulnerability. A bombshell report reveals 95% of firms get zero return on AI, echoing the dot-com bust. With the Magnificent Seven now 34% of the market, are millions of passive investors unknowingly trapped in a bubble set to pop? Finally, the IMF upgrades growth, but hides a critical warning. A new trade war could trigger market chaos, rocking global supply chains. The fund's optimistic outlook is built on a dangerous assumption that the number one risk it identifies will simply vanish. With a stronger dollar already tightening global finance, is this upgraded trap for unprepared investors? Quiet on the surface, but smart money is already reallocating. While US markets are shuttered today for the Martin Luther King Jr. holiday, the geopolitical machine has been working overtime, creating a deceptive calm before tomorrow's opening bell. The silence on the trading floor masks a storm of policy shifts and structural risks that will confront investors immediately upon the Tuesday restart. We enter this holiday pause with a stark divergence in market structure. The S&P 500 is sitting near record highs, up nearly 19% year to date, while the tech-heavy Nasdaq is barely clinging to a 1% gain. This gap is telling. Capital is rotating aggressively out of growth and into tangible assets, and the breadth of this rally is narrowing dangerously. The market is no longer rising on a rising tide. It is being held up by specific cyclical pillars while the growth engine stalls. Why is this Tuesday reopen so critical? Because two structural pillars of the market, trade stability and central bank independence, are shaking simultaneously. First, the Greenland dispute has escalated from diplomatic rhetoric to hard economic threats. President Trump's deadline for 10% tariffs on 8 NATO allies hits on February 1st. This isn't just noise. It is a looming tax on European imports. From a macro perspective, markets are facing a two-stage shock. Stage one is the immediate uncertainty premium building in luxury goods and industrials with European supply chain exposure. We are seeing margin compression priced into these sectors before a single tariff is levied. Stage two, if these tariffs stick, is structural inflation. Historical precedent suggests that if the trade war expands, we could see significant downward revisions in GDP forecasts. Then there is the unprecedented pressure on the Federal Reserve. The Department of Justice investigation into Chair Powell strikes at the heart of monetary autonomy. While the dollar has recovered, the risk isn't currency valuation, it's policy paralysis. If the Federal Open Market Committee feels backed into a corner, they may hold rates higher for longer just to prove they cannot be coerced by political pressure. JP Morgan is already forecasting no rate cuts until 2027, a stark contrast to the Goldman Sachs view of cuts this summer. If the labour market remains as resilient as the recent 4.4% unemployment data suggests, the Fed has zero incentive to cut, leaving high multiple tech stocks exposed to valuation gravity. In the sector trenches, we are seeing a fascinating paradox in technology. While mega cap tech stocks have faced valuation compression from rising yields, the underlying infrastructure story just got a massive vote of confidence. TSMC, the world's most important chip maker, raised its capital expenditure guidance to $54 billion for 2026. This 37% jump isn't speculation. It is a hard cash commitment to AI demand. It signals that the data center build-out is nowhere near finished. While stock prices for companies like Nvidia and Microsoft are consolidating, the capital spending pipeline suggests the AI megatrend remains structurally intact. Conversely, the financial sector is wrestling with its own regulatory shock. Trump's proposal for a 10% cap on credit card interest rates sent lenders like Capital One and Synchrony Financial tumbling over 6% last week. While analysts argue the legislative hurdles are high, the mere existence of this proposal creates a regulatory overhang that is actively compressing valuations in consumer finance. Investors are clearly favouring traditional investment banks like Morgan Stanley and Goldman Sachs, which reported surging investment banking revenues over consumer-facing lenders exposed to legislative risk. This matrix of uncertainty is fueling a quiet but powerful rotation into tangible assets. Gold has shattered records above $4,600 an ounce, and silver is trading above 90. This isn't just inflation hedging, it is a geopolitical risk premium being priced in real time. The materials sector is leading year-to-date performance because capital is seeking safety in physical value rather than future growth promises. As we look toward the Tuesday open, all eyes turn to Netflix. Reporting tomorrow morning, this is the canary in the coal mine for the growth trade. If Netflix beats expectations and raises guidance, it could validate the tech sector's fundamentals despite the macro noise. If they stumble, the rotation out of growth could accelerate. The market rhythm has shifted from a liquidity-fueled rally to a news-driven obstacle course. The next 48 hours will determine if the S&P 500 can hold its breakout levels or if the geopolitical weight drags us into a deeper consolidation. Heading into today's open, a warning shot is being fired at the heart of the market's biggest story, artificial intelligence. Michael Burry, the investor made famous by The Big Short for predicting the 2008 crash, is now betting against AI chip giant Nvidia. So the thing is, Burry's bet might be targeting a specific critical vulnerability. Nvidia's dominance creates a massive geopolitical choke point. The company has a near monopoly on the high-end GPUs needed for AI, but virtually all of them are manufactured by one company, TSMC, in Taiwan, using a specialized process that is already facing capacity shortages. This concentrates systemic risk, making the entire AI boom vulnerable to geopolitical shocks in the Taiwan Strait. We've talked before about TSMC as a single point of failure. It controls roughly 72% of the most advanced chips in its pricing power, with gross margins near 60%, is signaling tech-specific inflation that could complicate the Fed's last mile. Now, the industry is trying to diversify suppliers, think AMD and newer entrants like Cerebras, but that shift is early, which is exactly the kind of fragility a contrarian like Burry might be keying in on. This comes as a growing chorus of critics argues the entire AI boom is a bubble on the verge of bursting. The AI capex surge is colliding with power constraints, the end of cheap compute theme, which adds a structural cost floor that's hard to ignore. The central figure in this backlash is tech critic Ed Zitron, who argues the financial architecture of AI is a house of cards. His killer fact: a recent MIT report found that 95% of companies trying to integrate AI are getting zero return on their investment. This leads to the jaw-dropping numbers. OpenAI has reportedly committed to spending a staggering $1.4 trillion on AI infrastructure, yet its projected revenue is only around $20 billion. The economics just don't add up. That spend isn't just dollars, it's also electricity and grid capacity, with OpenAI's deal with Cerebras alone having a 750 megawatt power footprint, enough to run a small city. Now, get this, it's a scenario that echoes a painful lesson from history. The dynamic looks a lot like the dot-com era's fiber optic bubble. Back then, companies spent billions laying fiber optic cable, assuming demand would be infinite. When that demand didn't materialize, those assets had to be written down, triggering a massive crash. The fear now is that these multi-billion dollar data center investments are the new fiber optic glut. In fact, Del Oro Group reports that hyperscale data center capital spending has already surged 82% year over year, driven almost entirely by AI. If external customer demand doesn't show up, a write-down of these assets could trigger a tech-led recession. And if profits don't keep pace with this tsunami of investment, that's classic bubble risk. Zitron claims the business model is broken, saying the more someone is a power user of these platforms, the more they're going to cost you. This is almost the inverse of how the valley works. The core conflict for the market is the massive disconnect between hype and reality. The Magnificent Seven tech stocks, including Alphabet, Microsoft, and Amazon, now make up 34% of the entire S&P 500 index, largely driven by AI optimism. What really brought this to a head is the rise of passive investing. Millions of people have their retirement savings in S&P 500 index funds, like the popular SPDR S&P 500 ETF, which trades under the ticker SPY. This means a sharp correction in just this handful of stocks could drag down the entire market, hitting average household wealth much more directly than past tech busts. But Zitron alleges much of the supposed revenue is just these giant companies paying each other in a circular loop of deals. He claims that if you remove these hyperscalers from the equation, the real market for AI computing revenue is less than $1 billion. This all sets the stage for a critical test as big tech companies begin reporting annual earnings. Traders will be watching to see if they reveal concrete, profitable AI revenues or if the skeptics are right. As Zitron warns, without real profits, the trillions being spent on data centers could end up being what he calls the largest laser tag arena construction of all time. So, as we head towards the opening bell, the battle lines are drawn. At the open, look for how traders position themselves in the NASDAQ 100 ETF, the fund with heavy exposure to these tech giants that is often traded under the ticker QQQ. Any weakness there could signal growing nervousness. A key signpost to watch will be the ratio of AI infrastructure spending to actual revenue from external AI services. If that ratio looks unhealthy, it will pour fuel on the fire for skeptics like Burry and Zitron. Also, keep an eye on the VIX, and if the energy and data center inflation narrative builds, longer redated yields from the internal risks brewing in the AI bubble, let's shift to the major external threat that could pop it. The International Monetary Fund has just issued a stark warning. A renewed trade war could be the single biggest risk to global growth, with the potential to trigger a backlash in financial markets. This is where the situation takes a more complex turn. The fund is actually upgrading its outlook, projecting resilient global growth of 3.3% for this year. It's even raising its forecast for the US economy, citing a surge in technology and artificial intelligence investment. This creates a clear conflict, a market propped up by a powerful tech boom, now facing a massive political threat. And, believe it or not, this tech boom isn't just hype. We're seeing it in the data. A key leading indicator to watch is private investment in intellectual property products, or IPP. This measures real business spending on things like software and R&D. In the last quarter, this IPP investment grew at a 7.2% annualized rate, blowing past expectations. This is the fifth straight quarter of growth, showing a sustained push by companies into technology. This is the engine the IMF is talking about. The core question for the market is whether this powerful AI investment cycle can structurally outpace the drag from any new trade tensions. At the open, look for how the NASDAQ 100 ETF, QQQ, behaves relative to the broader S&P 500 index. Remember, that kind of leadership gap can also amplify concentration risk. Watch the VIX for any pop that signals stress under the surface. This connects directly to the Greenland-linked trade brinkmanship we've been tracking. The report directly calls out the risk of Donald Trump's tariff war escalating, warning it could blow its own optimistic forecasts off course. The threat is not abstract. As world leaders prepare to gather in Davos, Trump has threatened sanctions on 8 European nations, including the UK, over military deployments in Greenland. In a joint statement, those countries warned his threats risk a dangerous downward spiral for transatlantic relations. We know the tariff ultimatum was set to escalate from 10% around early February toward 25% by early summer, despite a fresh UK-US trade deal that was supposed to shield against exactly this. And the legal basis for those powers under the IEEE has been under Supreme Court review, which means policy could swing abruptly on a ruling. And that dangerous downward spiral isn't just diplomatic language. It has real, measurable economic consequences. When we place this threat alongside recent history, the potential fallout becomes clear. For instance, when the US imposed a 25% tariff on imported vehicles and parts, the impact was immediate and severe. German car exports to the United States, think BMW, Volkswagen, and Mercedes-Benz, slumped by almost 14% in just the first 3 quarters of that year. It's a stark reminder of just how quickly these integrated supply chains can be broken. So as you watch the market open, keep an eye on sectors with heavy transatlantic exposure, like automakers and aerospace. They could be the first to react to any new headline. However, if you zoom out, you'll see another layer of strategy at play. The very strength of the US economy powered by this AI boom could create its own problems. It's what economists call divergence, where the US grows much faster than Europe and other regions. This strong growth tends to push the US dollar higher. And a stronger dollar, tightens financial conditions for the rest of the world, making it more expensive for foreign companies to borrow and pay debts. This could pressure other central banks, like the European Central Bank, to react, potentially leading to major volatility in currency markets. So a key thing to watch today is the US dollar index. But that's not the whole picture. The real turning point is a major credibility challenge built right into the IMF report. The fund's optimistic baseline forecast explicitly assumes that the number one risk it identifies these very trade tensions will simply fade away. The upshot is that any investor who only reads the optimistic headline and uses that baseline for their strategy may be seriously underhedged for the very alternative scenario of a trade war that the IMF itself outlines. It's a classic case of read the fine print. This all sets the stage for a tense open. The IMF's report paints a picture of an economy powered by a historic AI investment boom, but one that is now directly threatened by a potential trade war. The key takeaway for investors is that the biggest risk to the market may no longer be economic, but purely political.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.